Meta just took a beating. It wasn't a slow drip. It was violent. One earnings call and the stock ripped lower. Now everyone's asking the same question. Is this a gift or is this a warning? Because on the surface, this looks like a dip, but underneath, something's not adding up. When one of the biggest names in tech gets smoked like that, there are only two possible outcomes. Either the market just mispriced a titan, or it saw something coming that you didn't. This is where people lose money, not from bad stocks, but from assumptions. There are two companies in front of us right now, both in advertising, both using AI. One of them is everywhere. The other, almost nobody talks about it. But one is scaling efficiently, the other is hiding behind momentum and mass. And here's the catch. When things finally break, the crowd always figures it out last. So before you start buying the dip, ask yourself a better question. What if Meta didn't just drop? What if it got exposed? Most people won't ask that question. They'll just keep buying, hoping it comes back. That's how portfolios bleed quietly. But first, here's something every investor needs to hear. Most investors are losing money and they don't even know it, not because they picked the wrong stock, but because their cash is sitting idle. Moomoo isn't just today's sponsor. They're the only platform I know that actually pays you up to 8.1% just for parking your money. Moomoo is literally giving away stock from one of the most valuable companies in the world, NVIDIA. Fund your account and you can get up to $1,000 in NVIDIA shares. No guessing, no hoping, just free stock based on how much you deposit. It's real. It's running now, but only through my link in the description or this QR code. AI is changing the game, and Moomoo is using it the way it's supposed to be used. Instead of spending hours reading reports, watching charts, or chasing headlines, Moomoo's AI stock analysis pulls it all together in seconds. It scans everything. Earnings, charts, sentiment data, and gives you the key facts you need to make smarter investments. You want edge? Moomoo gives it to you. Their next day trend projection shows where the stock might go tomorrow, visually, no guesswork. You also get free Morningstar research just for funding your account with $100. Aggregated news, institutional ownership, insider activity, short interest, technical sentiment, it's all there in one place. Robinhood doesn't do this, Webull doesn't either. If you're serious about investing, Moomoo's already playing at the level you're trying to reach. Here's what you get. Up to $1,000 in free NVIDIA stock, up to 8.1% APY just for parking your cash, and commission-free trading on stocks, ETFs, and options. But here's the part you need to get right. You only get this deal if you use my link or the QR code on the screen. It's running now, but only through the link in the description or this QR code. The two titans, one you know and one you're probably not thinking about. Most people see a name like Meta and stop thinking. They assume scale means safety. They assume being big means being right. They assume recognition means return. And that's exactly how investors lose money. Not from bad picks, but from lazy ones. Because here's what you won't hear on CNBC. There's another company called AppLovin playing in the same space. It's smaller, it's quieter, but it's not playing the same game. It doesn't own a social network, it doesn't chase headlines, and it's not trying to be everything to everyone. Yet somehow it's competing with Meta in the same arena, attention and ad dollars, and doing it with a fraction of the noise. One of these companies is building reach, the other is building results. But from the outside, they both look strong. This is what makes it so dangerous. Because if you're just betting on size, brand, or reputation and ignoring what's under the hood, you might be backing the wrong machine. So the question isn't which one looks better, the question is which one actually performs when it counts. Most investors have no idea what AppLovin actually does, which is funny because it's probably the most efficient ad machine nobody's watching. AppLovin doesn't sell eyeballs, it sells outcomes. Advertisers don't pay unless the ad works. That's not marketing, that's performance. That's a machine built to make people money, or it doesn't make anything at all. Now think about that for a second. If you're running a business and you've got $500,000 to spend on ads, here's your choice. You give it to Meta, pay up front, cross your fingers, and hope something hits. Or you give it to AppLovin and you only pay when the ad makes you money. Which deal are you taking? Exactly. That's not a trick question. It's the difference between selling attention and selling results. With Meta, you hope your ad works. With AppLovin, you only pay when your ad works. AppLovin's engine is called Axon, and it runs on real-time data, predicts performance before the ad goes live. It doesn't throw ads at people. It calculates, it targets with surgical intent, and it only fires when the probability of success is high enough to justify the cost. AppLovin only gets paid when the ads produce real revenue. That's not advertising, that's racketeering with math. Meta charges you to show up. AppLovin only charges when the money shows up. One sells attention, the other sells profit. If you still think those two businesses belong in the same category, go start a lemonade stand and pay yourself in likes. Let me know how far that gets you. AppLovin isn't trying to become the next Meta. It doesn't need to. It just needs to stay lean, stay accurate, and keep compounding revenue that's actually tied to business outcomes. No hype, no noise, no begging for your attention. Because when your model is built on performance, you don't need to scream. You just win. Some people talk about Meta like it's invincible. It's a massive platform. It has immense reach, and it generates endless cash flow. But here's what many investors overlook. Meta invested billions in the metaverse. That was the strategy. That was the future. And it failed badly. They took a big risk, they missed big time, and they're still dealing with the consequences. To their credit, they shifted back to what works, the ad model. That's the engine that actually generates money. I respect that. I own quite a bit of Meta stock, so I'm not just observing from the sidelines. I'm invested. However, just because I own shares doesn't mean I'm unaware of the risks. Now they're pouring billions into AI. This time it seems like the right direction, but how well do they carry it out? That's the part that remains to be seen, because if the same company that misjudged the metaverse is now leading the most costly tech competition, the stakes have risen significantly. Meta has the scale, but the last time they made a big bet, it resulted in a disaster. And this time, they're going all in, again. If they succeed, they could set themselves up for the next decade. But if they fail, they might not get another chance. Yes, Meta still controls distribution. Yes, it still grabs attention. But you don't earn money for just reach. You earn money for results. And right now, advertisers are watching closely. So here's the question. What happens when advertisers stop paying for mere noise and start demanding results? The face-off. This isn't a debate, it's a fight, round by round, no emotion, just results. Let's see who can take the hits and still stand up. Round 1, revenue growth. Meta forecast, 21.4%. AppLovin forecast, 22%. Winner, AppLovin. It's close, but the edge goes to the challenger. Slightly faster growth while staying under the radar. Round 2, net profit margin. Meta, 30.9%. AppLovin, 44.9%. Winner, AppLovin. This isn't a jab, this is a clean shot. AppLovin keeps more profit per dollar, almost 50% margin. That's absurd in this business. Round 3, free cash flow margin. Meta, 23.7%. AppLovin, 53.9%. Winner, AppLovin. This is a body blow. AppLovin is a cash flow monster, more than double Meta's margin. This isn't doing well, this is elite. Round 4, cash return on invested capital. Meta, 19.6%. AppLovin, 72%. Winner, AppLovin. This round is brutal. AppLovin squeezes out more cash per dollar invested than almost anyone in the market. It's surgical. Round 5, the PE ratio. Meta, 29.8. AppLovin, 119. Winner, Meta. This round swings back to the defending champ. Meta is simply cheaper on paper. AppLovin is priced like it can't miss, and that's dangerous. Round 6, profit-adjusted PE ratio. What is this? You take the PE ratio and divide it by the net profit margin. This tells you how much you're paying for every 1% of profit. The lower the number, the better. Meta, 0.96. AppLovin, 2.65. Winner, Meta. This is the tiebreaker. Meta is 2.8 times cheaper per unit of profit. That's not a debate. That's math, and this is a critical round. But here's what AppLovin has that Meta doesn't. Upside leverage. Their model only gets stronger the more results they deliver. If execution keeps compounding, they could close this gap fast. So here's the final verdict. 3 rounds Meta, 3 rounds AppLovin. This is a split decision, and Meta wins today because of the profit-adjusted PE being weighted. That's the tiebreaker. No excuses. But let's not pretend this wasn't a war. AppLovin hit harder in the middle rounds. It landed the bigger shots. Meta came out on top, but make no mistake, they were on the ropes, and they don't want a rematch. This was like watching a veteran champ outpoint the rising killer while quietly praying the bell would ring before they got knocked out. So if you're a Meta investor, you survived, but you better be watching that corner. And if you're looking at AppLovin, you just saw what happens when a performance-based model starts landing punches Wall Street doesn't expect. Are either or both stocks long-term holds? The Meta bull case. Meta still owns the ecosystem. Billions of users, control over the ad funnel, absolute dominance in global reach. If they execute an AI, their monetization potential goes vertical, layered directly onto existing infrastructure. They've got scale, cash, and optionality. The Meta bear case. They burned billions of dollars chasing a metaverse fantasy. That execution failure wasn't small. It was historic. Now they're betting again, this time on AI. Right direction, but the execution risk hasn't gone away. They're still bloated, still reactive, still hoping scale will save them. But ask yourself this, did anyone think MySpace would vanish when it was on top? Giants don't fall fast, they fall slow until they don't. Is there a moat? Yes, it's real, but it's static. Distribution protects the empire, not the future. The AppLovin bull case. AppLovin doesn't charge for attention, it charges for performance. The Axon engine feeds itself. More data, better targeting, higher returns. That creates compounding precision at scale, and the margins are brutal. Advertisers don't guess with AppLovin, they spend to win. The AppLovin bear case. Narrow focus, high expectations. It lives or dies on execution. One bad earnings miss and the multiple collapses. Mobile gaming is volatile. If spending slows or AppLovin loses its edge, it could bleed fast. Is there a moat? Yes, and it's evolving. Every campaign makes the system smarter. That's a feedback loop Meta doesn't have. These are two competitors with very different business models, fighting for the same customer dollars. Now let's talk about execution, not opinions, not feelings, just the positions we hold and why. I'm still holding my Meta shares. I'm profitable on the position, but I'm watching it closely. 715 is a major resistance level. If Meta climbs above that and holds, I'll stay in. But if it starts to weaken, I'll lock in profits and close the position. This isn't about loyalty. This is about business. And I don't want to have a winning position turn into a losing position. Meta needs to show me the money. With AppLovin, I'm not chasing a breakout. I've been selling puts and generating income while AppLovin fights a double top. That's bearish until proven otherwise. It needs to close above $730 to prove it's breaking out. Until then, I'm happy collecting option premiums and keeping my risk small. And let's be clear, AppLovin is expensive and priced for perfection. That means high risk, high reward, which is exactly why I only want a small position. I'm not loyal to tickers, I'm loyal to the results. Now let me ask you something. Who else is showing you how to actually make money, not just guess at it? This isn't theory, this is real execution. Mike closed his Google cash secured put for a 67% profit. Why? Because now he gets to repurpose his cash into another position. This is what disciplined investors do. Wreaks Havoc pulled in over $12,000 last week with a 71% win ratio. No hype, just clean exits and repeatable setups. And this is my account, $6.02 million, up $2.53 million this year, which is a 72.5% gain year to date. I'm not trying to impress you. I'm showing you what's possible when you stop guessing and start operating like a real investor. Inside my Patreon, here's what you get. Real-time trade alerts, every entry, every exit, every reason. Daily market breakdowns, no fluff, just what matters. My daily hot stocks, the tickers I'm watching right now, and access to the sharpest, most disciplined trading community you'll ever find. And it's just $1 a day. Let that sink in. You probably spent more on coffee this morning, and that didn't make you a cent. So if $1 a day sounds like a lot to you, then the market's going to eat you alive. Because if you can't turn $30 a month into better investing and bigger wins, then you don't have a money problem. You've got a discipline problem. My Patreon group isn't for everyone, but if you're serious, then it's the most profitable dollar you'll spend a day. Cancel anytime, no pitch, no pressure, just execution.